afternoon, traders. Happy Friday. It's a pretty great Friday, wouldn't you say? I hope you are having a fantastic day. I have quite a lot to cover today. And so I'm going to roll pretty quick because I really want to give you guys the most value possible. So Dave is here, Randy's here, Alex. How you doing, my friend? Happy Friday to all. Exactly. Okay. So let's jump right into this. I really have a lot to cover today. Oh, I'm gonna have to share system audio. That was it. Okay. All right. Welcome to the OVTLYR Trading Room. Oh wait. Oh, got ahead of myself. I got ahead of myself because I didn't want to forget about this. Or did I? Did I get ahead of myself? No, I didn't get ahead of myself. Shut up. I'm trying here. Welcome to the OVTLYR Trading Room. This is smart trading made simple. Save time, make money, start winning with less risk. And for those of you who don't know me, my name is Christopher Ewell. I've twice been awarded top 100 people in finance. I've been successfully trading since 2009. I am a partner with OVTLYR, and this is my style of trading using the OVTLYR data, and I call it the golden ticket trading strategy. So real quick, how does OVTLYR work? It's a 4-step process. Number one, OVTLYR monitors how investors are reacting to changing market conditions, the news, price movements, and the economy. OVTLYR determines if investors are acting irrationally fearful, or greedy, and by how much. OVTLYR gives buy and sell signals when these irrational behaviors reach an extreme, allowing you to get into the stock before the outlier move happens. So I want to make sure that I cover that every single day because honestly, we have so much that we have to cover today. But I want to make sure that you understand what OVTLYR is and how it works. I think that's super, super critical. And we're going to go to today's member highlight. This is something I'm actually going to start bringing up hopefully every day. Now that we have a really active Discord and we've got some really incredible OVTLYRs who are putting their time, their effort, their opinions, everything in the Discord, I really want to be able to focus in and showcase these guys in the member highlight. All right. Well, that today is actually going to be Brian. Brian is our one person who dropped anything in the share your big winners section this week. So congratulations, Brian. Won the $10 Amazon gift card. Now we do this every week. Every single week we do this. All you have to do is go over to the share your big wins in the Discord and just tell us how you used OVTLYR this week. That's it. Brian just dropped a screenshot and Brian earned a $10 Amazon gift card in the process. So Brian is the winner of this week's weekly winners circle. Congratulations, Brian. Way to go, dude. Okay, so April will send that to you on Monday. So with that out of the way, like I say, I really actually want to start showing this off every single day, right? So be sure you share your stories in the Discord because the very first rule of OVTLYR is you tell everyone about OVTLYR, right? The very first rule of OVTLYR is you tell everyone about OVTLYR, and the way you do that on YouTube is by hitting the like button. So do me a favor. I know you're already subscribed, but go down below and tap that like button for me. Let's catch up on the chat here. Wes says, hello, everyone. Tug is here. Good afternoon. Just ordered the book. Very good. Very good. We're going to cover that in just a minute, Tug, for those of you who don't know what he's talking about. Michael's here. Goran's here. Cam is here. Max is here. Max, I'm really glad you're here. Brian says, you look spiffy today. Thank you. I'm going to go and share too much. Give me a second here. I'm going to share too much. Because when it comes to figuring out what to wear, I'm really clueless, honest to goodness clueless. And this is a project that I've been working on for a while. So there's several YouTube channels that I would watch, and they have all these different, outfits that they'll put together. And so this is a slide deck that Rudes, my editor, and I have been working on. I've now got it up to 65 slides. Some of them include James Bond, of course. Some of them are from different dudes, right? And so now what I'm going to do, not just here, but also in my personal life, which I'm excited about. I live in Texas, so it's hot as hell, so I can never dress up in the summer. But in the fall and winter and early spring, I do like to look fancy. I think it sets the tone, right? I think it sets, when you walk into a room, people treat you differently. And like I say, in Texas, it's really difficult to do in the summer. But one great example I have of that is I wore almost exactly what I'm wearing right now into Costco one day. Just as you know, I shop at Costco. In fact, this shirt came from Costco. You can get some great stuff at Costco. Walked into Costco one day, and this lady came up to me and she's like, "You look incredible. I just wanted to let you know you look great and you look like you're somebody really important. So I think this is awesome. Have a great day." And I was like, "Wow, thank you." So it doesn't take much, right? So I created this lookbook here, and it's honestly just a bunch of like pieces, right? You can mix and match to fit your wardrobe. But I'm going to be using that random number generator as I like to use. So now I have 65 slides. So it's like, in fact, let's do it right now. Hey Siri, pick a number between 1 and 65. All right. I don't know if you could hear that, but she said random number is 3. I'm going to go over to slide number 3 and pick from something on this this slide here. Now, this is a look. I like this one. I would go with this one, right? Nice clean white shirt, dark jacket, dark pants, and white shoes. I could pull that off. That'd be great. So anyway, I like to dress fancy. It's just been a while. All right, like I said, sharing entirely too much. Cam says, way to go, Brian. And Randy says, congratulations. Brian saying, thank you. No trades equals no big wins. I know. But you need to share that. Oh, the lookbook. I can share that. Give me 2 seconds here. Hang on. I'll share with you. Copy link. Let me change the settings here on it. Oh, I don't own this. My editor owns this. Let me make a copy. File, make a copy. Entire presentation. Hold on, I'm gonna share it with you. All right, now I own it. Okay, here we go. All right, anyone with the link can be a viewer. Copy link, drop it in the chat. There you go. Enjoy. All right, cool. So back on topic here. Only 200 more to go. Oh yeah, 200 more slides, right? Brian knows I like to do tons and tons of slides. Randy says, Hawaiian shirt and flip-flops. Your wife better watch out. Daggum right she is. Brian says, that's a great way to make less decisions and have more brainwaves for important things. Yeah, Brian, like, I don't have to think about it. Just random number generator. Give me 5 different things to choose from. Basically, in men's style, there's like, you know, a switch of a shirt, switch of a jacket, switch of pants, and switch of maybe a vest or a sweater. Yeah, it's not much. Dave says, I work from home and I still get dressed up nicely. Just puts me in the professional mindset. All right, cool. All right. So with the golden ticket trading strategy, it always starts with the market. The market's going to tell you which direction it's going. The 10 over the 20, price over the 50 is bullish. And that's exactly what we have. 10 is over the 20, price is over the 50. I'm going to move this line up a little bit. So we are definitely in bullish territory right here. This is all-time highs. I went ahead and marked that on here. It's come up into this order block. If it closes above this order block disappears. We went into tons and tons and tons of information about how great order blocks are yesterday. So definitely go back and watch yesterday's live stream if you didn't get a chance to watch that. Incredible what they do. But if it closes under that, I would assume that there could be a reversal in line here. Now, the next step in the golden ticket trading strategy is to go to OVTLYR, which I have actually closed, and look at the market breadth. Market breadth and the SPY signal. The SPY actually has a sell signal. So we've got a bullish trend, a sell signal on the SPY, and bearish market breadth. Although it may have flattened out. It may have flattened out right here. So we could see a bullish return on the market breadth here. And we might see a buy signal come through here. But in the meantime, I'm not going to do anything, right? Because I need all that together to make the master key. The SPY signal, the market trend, the market breadth, and then the sector breadth of the stock that I pick. Now, I'm really glad that Max took the time to go in the Discord and share some of his experiences and everything that's going on with him. And I wanted to just take a moment to really work with you. Think of me as your coach. Think of me as your mentor, right? I'm literally here for you. This is as close as I can give you as to one as possible. And because of that, you are allowed to ask any questions you want, give any opinions you want. And even if I don't agree with them, I'm going to give you my opinion back. And you're definitely welcome to not agree with that either. But the point is that I'm going to give you the best that I can, but I want you to give me the best that you can, right? I want you to give me the best you can because I'm here for you. You don't have to be here. I don't have to be here. Both you and I are choosing to be here together. So let's be fully embraced into this. Tug says, got it. Now to Costco. Brent says, I started a new job. Congratulations on that new job, Ryan. I'm glad it worked out. And he's going to dress up nice like Dave. Cam says, how do I show my avatar? You've got to go into your Google settings. I don't know how to do that. It's been 100 years, but my avatar on my personal channel is a little picture of me. And I set that up in Google. So that would be how you do that. So let's go to the Discord. Okay. Max had asked about a different trading strategy. And I just gave some notes that, look, I'm not familiar with this strategy, but I'll put it to you this way. Any trading strategy has the potential to work if the wins are bigger than the losses and an acceptable winning percentage. The problem comes down to individual implementation. Most people want to trade, don't comprehend how to take a loss. Now, if you see some errors, I was doing this on Siri, so it may not be perfect. Even with an 85% win rate, hang on, my camera just did something. So my camera is kind of cool. It has gesture tracking. And when I raised up my hand like that, it started to do something. So I had to turn that off. Even with an 85% win rate, I struggled for years because I was unable to take losses. Now, you may have heard that story where I had an 83% win rate. And at the end of the year, I was down and I didn't understand why I was down. If I'm winning so much, why do I have an issue with making money on balance, right? And the issue was that I was losing 10x what my winners were, right? So even with an 83, 85, 90% win rate, if you're losing 10x as much as each one of your one winners, it's never going to work. It will never mathematically work. So basically, I don't want to give an opinion on any other trading strategy. I really don't. Other than it should have small losers, big winners, and an acceptable win rate. And that's where my strategy years ago broke down because it had big losers, tiny winners, and a high win rate, which doesn't mathematically work. And it has to be something that fits with the individual trader's personality and temperament, right? Some people, the way that they trade, they may have 20 to 30% winners, yet those 20 to 30% winners are huge, right? And I don't know how they do that, and I can't claim to teach you how, but that's what they have been able to figure out. But in the process, they understand that in order for those 20 to 30% of times for it to win, they got to cut losses like crazy, right? Anytime it moves against it, cut. Anytime it goes down a penny, cut. Whatever the case is. He was also mentioning that he joined during a time when I wasn't putting on a lot of trades. And I can understand how that's frustrating. Completely understand. OVTLYR does deliver new opportunities every single day. But I get that if you're looking for someone to be the lead for you, to be that mentor like I was talking about a few minutes ago, it can absolutely be frustrating if there's no trades going on. Then I replied and said, there's no setup worth taking unless it's perfect. Everything else is noise. Larry Height, who was one of my mentors, he's a market wizard and the very first $1 billion hedge fund manager, taught it to me this way. Do not take any trades unless they're set up. If you take a trade that's not set up, you have completely invalidated your model. If you don't take a trade that is completely set up, you are once again completely invalidating your model. Right? So the moral of the story is don't trade unless you have a reason to. And I just wanted to preface this and say, that's just the way I trade, but OVTLYR does deliver you new opportunities every day. And one of the great things about being in the stock market is that you don't have a boss sitting there telling you when to take trades or when not to take trades. And that unlimited freedom has been the downfall of many traders. After I typed that out, those are not my words. Those actually came from this incredible book right here called Trading in the Zone. And after I typed that out, I got to thinking, like, I feel like anybody in our Discord, anybody who's watching on the live streams, they need this in their lives. So I put this out there and I said, hey, everyone, I'm assigning some homework over the weekend. Go order this book on Amazon, Trading in the Zone by Mark Douglas. Buy it new, buy it used. I don't care what you pay for it. You could pay $6. You could pay $28. Whatever the cost is, it's worth it to you. It will be one of the best investments you make for the rest of your life. I don't know how well this is going to come through, but I have probably 60 tabs in this book here. And I'm just going to pull, literally randomly picking one. Page 47. If you have to win, if you have to be right, if you can't lose or can't be wrong, you will cause yourself to define and perceive categories of market information as painful. So if you have to win, if you have to be right, you're going to be looking at the market every moment of the day, and it's going to be painful. I mean, I just pulled that at random, right? Because I've been there. Have you been there? Alex says, SPY had an uptrend this morning on OVTLYR. It sure did. It sure did. I got that email. Did you get that email too, Alex? I saw that email, and so I clicked over here real quick, and it did go into the green. Oh, you can't see my screen. It did go into the green uptrend overlay. Yeah, I saw that exact thing. Goran says, Etsy is up 8% today. Wow. Are you saying that we sidestepped by following the rules? That we sidestepped an issue? Because it looks like to me we did. Randy says, I messed up rule number 2 by not taking some trades that I should have. Yeah, that's the thing, right? You've got to take the trades that's set up, and you have to not take the trades that aren't set up. Anything else invalidates your model. So well said, Randy. Peter, good to see you. Some of the smartest traders on Wall Street just can't sit down and wait. Trend Followers book. Yes, the trend following book is absolutely one of my favorites. But I want to work on trading in the zone. So like I say, I dropped a link on the Discord. Go get a copy. You could listen to it on Audible. It's also a great one on Audible. And then I dropped 2 links to 2 videos. These videos I personally saved years ago, and I will go back and occasionally rewatch them because they are so great. So what I wanted to do today, because I'm not trading, because we don't have a confluence of signals here, is go through the shorter of the 2. One of them is an hour. The other one is 2 hours. I'm going to play this at 1.25% speed, or yeah, 1.25x. So this will take 40 minutes or so, give or take. I'm only going to jump in when it's necessary. But the truth is, I don't need to jump in. You don't need my opinions. Mark Douglas, the man who wrote this book, the man who's going to be interviewed here, he's the one whose opinion really matters. And as I like to say, I just stand on the shoulders of giants, right? These men have pioneered so much in our industry, and all you have to do is listen and pay attention. We are blessed beyond belief in 2024 to be able to have access to these things. Imagine what life was like in 1914 when Jesse Livermore was trying to trade. How difficult that would be. And here we are 100 years later. You've got OVTLYR. You've got somebody coaching you directly through the internet every single day. You can reach out on the Discord and ask questions anytime. We're going to change the world. I'll put it to you that way. So Dave says, just bought the book on Amazon, $14.99. It's free on Amazon audiobooks. There you go. Go get it today. Like I say, whatever it costs you will be the best, one of the best investments you've ever made in your entire life. So I'm going to let this play, and I'm only going to jump in when I really feel like it. But honestly, you don't need my opinions. You just need to hear Mark himself.
Psychology in today's market is not an easy thing to master. It takes a lot of discipline and skill to become a consistent and successful trader. Here to talk to you about what you need to do in order to put your mind over the market is Mark Douglas. Mark has been a successful trader since the 80s and has written 2 books on trading psychology, both Trading in the Zone and The Disciplined Trader. You've heard me talk about them many times here on WTV, and he is here today to help you become successful traders. Mark, good morning. How's it going?
Good morning, Jared. Glad to be here, and I hope I can be of assistance to some of your traders who are viewing right now.
Mark, you know, last time we were together was at WiseFest, and had a lot of fun. I'm really excited you're here with me today.
Thanks.
So let's get started. First of all, you know, one of the main issues that I see all the time is that people don't use their method to its full potential. In other words, there's a negative correlation between what the trader ends up with and what he could have had if he just followed his methodology. Right. In your DVD program, you refer to this as the profit gap. This is a problem. You refer to it as a profit gap. And I think it's one of the least understood concepts of trading. Can you address this a little bit, this profit gap?
Yeah, that's actually a really good place to start because I think that more than anything, what your viewers want or what your customers want are consistent results. They want to be able to produce an income that, that they can rely on from their trading. And I'm sure that many of your viewers have already realized that getting a steady income is not such an easy task.
Yeah, and everyone seems to get trapped thinking that because trading is easy.
Right.
I'm only going to interject when I feel like it's needed. I agree with that completely because so many people want to get into trading and say, I want to make $10,000 a month. Dude, there's no way that I could promise you that. I don't care what you want. There's no possible way I could guarantee you an income in the market. Now, there may be months where you make 100,000 in a single month, and then you go 11 months and you make nothing. Would that still work for you? Really? Would it? Most people, it wouldn't. Most people, that 11-month downtime, it's like, I got to do something. Why can't I make money? But the 1 month pays for all those 11 months. So that's why I say I can't guarantee you any time frame, but you just have to show up.
Because it's easy to find yourself in a winning trade, which many people do.
Right.
They think it's also easy to become a consistent winner. Right. And it took a long time before it actually dawned on me that winning and being a consistent winner are two completely different animals, two different things. And in some ways, there isn't even a relationship between the two.
It almost seems like there's no relationship between the two.
Yeah.
That's what you're saying, right?
Yeah.
Yeah, that's a real hard mental barrier to break through. Mainly because, it's so easy to find yourself in a winning trade because winning actually requires no skill at all. In other words, unless you consider that, the being able to click a mouse button or, tap a pad is a skill. Right. And we don't have to have a reason or a good reason or actually any reason to put your cursor on the buy or sell button and then immediately find ourselves in a winning trade. And it could be a monster of a winning trade. And what did it take? What kind of what kind of skills did it take to actually experience this? Absolutely none.
Yeah. So it'd be natural to take the leap from, well, if it's this easy to win, it can't be that much harder to make a steady income. Like you said, it's that easy to click the mouse for me to sit there and make $5,000 or $10,000, and it must be pretty darn easy for me to sit there and make a living out of this. And that's what I thought for a long time, but that is not the case.
No, and that's exactly how I started out too. And I know, not unlike a lot of other people who are willing to, let's say, give up a real high-paying career to be a trader because they thought it couldn't be that hard.
So what makes consistency so challenging? What's the big hurdle there?
Well, we're gonna get into that, but at the most general level, I'm gonna say that it requires learning the type of skills that people just simply aren't used to learning.
Mental skills.
Mental skills, yeah, exactly. In other words, it requires mental skills. Most people assume that because their technical method gives them a signal to get into a trade, that if the method produces a high percentage of winners, it will equate to a consistent income, not taking into consideration that the proper execution of those signals requires mental skills.
Give us an example.
Proper execution of those trades. Proper execution of that setup, right? And to Mark's point earlier, like any trade you put on, like I could ask my 12-year-old son to walk in and enter a trade at any time, and it could win. The skill of making a winner actually is very easy, right? It's as easy as clicking a button. But so is the same as having a loser, right? It's a random outcome in that case.
Well, take for an example, a high school basketball player who, he'll go in the gym and practice throwing his free throws, maybe for even 2 or 3 hours a day. It wouldn't be unusual for him to be able to hit 50 in a row, would it? I mean, that's not out of the realm of reality, right? Okay, so the problem is that could he even hit 2 in a row if the circumstances were he was in the final game of the NCAA championship, his team is down 1 point, there's only a few seconds left on the clock, and he was just fouled.
Changed everything.
Yeah, under those circumstances, without the appropriate mental skills, hitting either one of those free throws is very unlikely. And regardless of how well someone could do it in practice, most people would choke.
So really the skills you're referring to, what you're talking about, Mark, is actually staying focused on the process, staying positively focused on the process itself, in this case, of throwing the ball, in our case, obviously, of trading or following your method, right, and not being worried about blowing it, about the consequences of what could happen if this trade goes wrong.
Exactly right. Just like what I'm going through right now. Trying to stay focused. Yeah, trying to stay focused on the process of this presentation and not blowing it.
What are you doing, fantastic?
Anyway, with trading, we may have a technical method telling us what to do and giving us the potential to generate consistent results. But like the basketball player, without developing the appropriate mental skills, it's unlikely we'll be able to do what our method, our trading plan is indicating without making a number of potential execution errors. In other words, to stay positively focused on the process of trading by doing exactly what we need to do, when we need to do it, without hesitation, reservation, or fear.
exactly what we need to do when we need to do it without any hesitation or fear. So that goes back to two things, right? Like we talked about. There's the type 1, let's call them type 1 and type 2. Type 1 error is you take a trade because it's subpar. You take a trade because it kind of fits your plan. You take a trade because you're bored and you want to do something, right? So people told you, hey, being a trader means being active all the time. And then a type 2 error is not taking the trade when it is set up, right? Maybe you just had a losing streak. You lost 6 in a row, 8 in a row. And now on that next trade, are you still going to take it? Or are you going to second guess the entire world? Most people second guess everything at that point. They say, my strategy must be completely broken. I have to upend everything and start over from scratch. But that 6th or 8th trade, that next one, could be the one that pays for all of those and more if you had only followed your predefined strategy. So we'll continue on.
Okay. That's interesting.
So you see, no matter how good a technical method is at generating winning trades, turning those winners into a consistent income requires the ability to do or not do some things that the method itself can't help us with. For example, our method can't force us to predefine the risk of getting into a trade. Or if we do predefine the risk, our method can't force us to take the loss that ends up turning into a bigger loss.
Right.
And you know,
two things that he just talked about, which is what we do for every single trade. And I really want you to pay attention and see the correlations of what we do on a daily basis to what he teaches, right? Because number one, we predefine the risk in every trade. Every single trade that goes on, you see exactly where I'm marking, where I'm going to get out if things don't go right. I'm predefining my risk. I'm predefining my risk on the chart, and I'm predefining my risk in position size. Those are two ways that you limit yourself to having as small losses as possible. You have to do those.
that's happened to everybody, okay? Our method can't prevent us from moving a stop closer to our entry point where we get stopped out and the market trades back in our favor. Our method can't prevent us from hesitating and getting in too late. Or our method can't stop us from jumping the gun and getting in too soon, where the signal to actually get in never really develops. And our method can't stop us from getting out of a winning trade too soon and leave money on the table. Nor can it prevent
you need to have a reason to get in and a reason to get out.
us from letting a winning trade turn into a losing trade without having taken any profit.
I know that all of our traders have experienced these issues. I know they have, and I think really what you're saying is that the methodology, and this methodology, folks, what we're talking about, we say the word methodology is the wise trade software, that's our method. And it can give us winning trades. We've seen, I know all of you have had winning trades, but it cannot give us consistent results if we're susceptible to making the kind of mental errors that you're talking about here, okay?
Exactly right. Yeah, that's exactly what I'm saying. And all the mental errors I just listed are the result of thinking, a result of thinking, believing, or assuming that our technical method is telling us what's going to happen next on a trade-by-trade basis.
Ooh, ooh, ooh. Okay. There is one word in the English language that drives me absolutely crazy when it comes to trading. I want you to try in the chat and guess what that is. It's one word, starts with the S, that when I hear somebody say it, when it comes to trading, I can tell you two things. They have no idea what they're talking about, and they have never traded before. I'll give you just a second, type it in. When I hear this word, it's like nails on a chalkboard. 5, 4, 3, 2, 1. Should. The stock should do this. The stock should have done that, right? My trades should give me this result. There is no possible way that you know what a stock should do. Let me give you a couple examples, right? Let's say that you're going out to your car and you push the button to start the car, depending on your type of car, right? It should start. If it doesn't start, there's a problem. But you can't relay that to a trade, because even if a trade is 100% set up in your criteria, it can still be a loser. So saying should is you are imparting what you believe will happen upon a stock when there's no basis in reality to determine if it should do this will actually happen. Tug said, sure thing. That was a good guess. Randy says, should. Sounds like CNBC, right? oh, stocks should go up after earnings, right? Or how about the good earnings reports, yet the stock price goes down? It shouldn't do that. Yeah, exactly.
And not understanding that technical methods aren't designed to do that. Right. Technical methods and patterns are designed to put the odds of success in our favor over a series of trades. It may not seem like it on the surface, but there's some profound psychological implications here. What this means is the outcome of the signals generated by any technical method on a trade-by-trade basis are unique and random. In other words, there's no way to know in advance what the outcome to any particular signal will be or what the sequence of wins or losses will be over a series of trades.
It's a mouthful.
Okay, and that's where people go wrong. There's no way to guarantee anything in the market, right? Even if it, in your opinion, should do this thing, it could do something completely different. It could outperform, and you could be so stoked, right? Would you at them go back and say, well, it should have only gone up $1, but it went up $5? How dare it? No. Every outcome is random, and that's why on the data that I keep, right, I like to keep a standard distribution curve, because I don't know where it's going to end up. But I do find that interesting, right? There's going to be plenty of winners. There's going to be plenty of losers. But you can't tell the trade where it's going to go.
and I understand what you're saying. I think, we need to, first of all, know that many of our viewers out there are experiencing the same sort of thing, okay? And they're probably going to have some trouble grasping this concept that by accepting the randomness of these outcomes, they can produce consistent results. That's an odd concept.
Yeah, that's exactly what I'm saying, Jared. I know it's somewhat of a paradox to think that events that have a random outcome can produce a consistent result, but think about it. This is the principle that's been used by casinos for hundreds of years.
Right.
Technical methods and patterns will give the individual trader the same kind of advantage the casino has over the individual player, if the trader can think about it from the proper perspective. On the other hand, if a trader who has generated his signal from a technical method hasn't learned to integrate this principle, this randomness principle, into his trading regimen, he'll undoubtedly find that trading can be one of the most frustrating, if not exasperating, endeavors he's ever chosen to undertake.
And I know there are a lot of viewers out there who may be experiencing frustration. In fact, I know there are definitely viewers who are experiencing frustration, but I'm not sure if they're making the connection that the reason because they don't believe in this randomness principle where you can generate consistent returns by looking at the outcomes of their trades as random and unique. Right. They have to be able to view that as random and unique. That's, I think, the big issue.
No, I know. And that's why we're here explaining it right now. You see, the frustration comes from our expectations. It's from expecting something from our technical method it just can't do. Technical methods define and identify patterns in collective human behavior. Right. Now, the patterns definitely exist. They repeat themselves over and over again. The problem is the outcomes don't always correspond with the patterns on a trade.
And that's how OVTLYR works, by the way. In case you were wondering, as we talked about earlier, the OVTLYR patterns, it looks for those fearful and greedy times, right? And then lets you know when those reach extremes. Mark just said those really do exist. Oh, that was kind of cool.
Trade-by-trade basis. So what I'm saying is that, yes, we have patterns, yes, and they repeat themselves over and over, and our minds just naturally think, well, I have a pattern that's consistent, I should have an outcome that's consistent with a pattern, right. and that's not what I'm saying at all. What I'm saying is that there doesn't have to be a relationship between the outcome and the pattern. Right.
And to that point, these patterns generate the buy and sell signals, but they don't generate, hey, you should expect an 8% return on this one trade, right? You can't say that there will be X outcome because we don't actually know what the outcome will be. That's why I like to give the example that, if a stock goes up $5 instead of $1, are you actually mad at it for doing more than you wanted? No, of course not. But would you also be mad if it went down $1? You probably would, but why? Right? There's no way you can control that except for position sizing and risk on the chart. But it's going to move in one way or another. And it's just data. It is, in theory, as likely to go up $5 as it is to go down $5. Mark is here. Smartest man in the room. Distribution curves. Now you're speaking my language.
So, and if the last trade was a winner, this trade, even if the charts are the same, even if we've got the same exact signal, the same looking chart, there's no guarantee that this trade is going to be the exact same as the past one.
Exactly. In other words, this trade, the trade I'm in right now, could turn out to be a winner. And does that mean that the next trade is going to be a winner? Absolutely not. This trade I'm in right now could end up being a loser. And does that mean that the next trade is going to be a loser? No, absolutely not.
And he's going to say this too. That's why every trade is unique, right? Every trade has the trade you put on right now has no bearing from any trade prior and no bearing on any trade in the future. This one trade is a unique circumstance, a unique event that cannot be replicated.
Yeah. This is interesting. I mean, I'm trying to, for us up here, you know, the goal, the main goal is obviously to take these concepts and reduce them down to the most simple of terms. So, you know, let's again back up here for a second. There are traders out there using Wise Trade every single day. They're getting the same exact patterns. Okay. But what you're saying is, even though the specific criteria is being used to identify the pattern, okay, for each signal, same criteria, same formula, same everything.
Right. The chart pattern can look exactly the same. Everything.
Right. The outcomes to each signal have no relationship to one another.
That's right. That's exactly what I'm saying. That there's a random distribution between wins and losses over any sequence of trades that you might look at. And so, you know, and again, this is a very difficult concept to grasp, but it's really the traders who have grasped it, let's say, and learn how to think in what I call probabilities. Okay. They're the ones that don't experience the same kind of, you know, the same kind of emotional trauma that the typical trader does, because they're expecting something that just may not happen. So for an example, if this trade's a winner based on this particular trade I'm in right now, based on the exact same criteria that, you know, or let's say I'm in a trade right now, or I'm getting into a trade right now, and the exact same criteria exists in the market that did the last time, I'm going to naturally expect it to be a winner if it was a winner the last time. Or I probably will naturally expect it to be a loser if it was a loser maybe the last time, or we had 2 or 3 losers in a row.
And this could be a source of frustration for traders.
Oh, absolutely. In other words, and that's exactly what happens. It is a source of frustration, because if I'm expecting it to be a winner and it turns out to be a loser, I'm going to be frustrated. Not only going to be frustrated, I'm going to be disappointed, and I may even feel betrayed, depending on how much kind of energy that I put into the idea that the trade is going to be right.
Well, how do we get over?
Because you are trying to tell the trade what it should do. There's that key word again. But if you just allow it to happen, either way, if you just allow it to happen and have a plan to get out, if it goes against you by whatever loss percentage that you want to assign to it, or let it work until you get an exit signal, then the anxiety goes away, right? When you know what you're going to do, when you know why you get in and why you get out, the anxiety goes away. The stress goes away, and especially when you position size correctly. And I know some of you have watched me put on trades in a flippant manner, right? Meaning it's like, wow, he just risked, you know, tens of thousands of dollars on this one trade with that little of information. Yeah, because I know exactly where I'm going to get in, and I know exactly where I'm going to get out. I know why I'm going to get in, and I know why I'm going to get out. And I'm not basing anything of my self-worth on the outcome of that trade. And if it works, awesome, I'm here for it. If it doesn't, that's okay too, because I'm limiting my risk. Sebastian, we are still live. It is for real. This is live.
I mean, how does a trader take, you know, okay, so I've done all the things right. I've got my charts lined up. I've done everything I was supposed to do. How does the trader at least begin to accept these sorts of things, or you know, how do they begin to remedy these issues? Well,
here we kind of have to get into the nuts and bolts of this, of just exactly how the markets work, because I think that one of the big problems, one of the reasons why people have such a difficult time with this, is because their initial exposure to the markets themselves is through electronics. Right. In other words, there's through electronics, there's a real disconnect between what you're actually participating in and what's causing, you know, you to want to participate in the first place. In other words, you know, markets started as exchanges, and there were, and so when you traded at an exchange, so you know that all prices are people-generated events. Correct. They are, and see, this is what people have to take into consideration. Everything happens because of what people believe. When you look at the nature of trading and break it down to its simplest components, what you have is everyone trying to do the same thing. There is no possible way that any of us can make money as traders unless we can buy low and sell high, or sell high and buy low. Correct. Is there any other way, Jared? No other way. In every market. In every market. So basically, everyone's trying to do the same thing, are they not? Yes. Everyone is doing the same things. Now, the reason why we have price movement is because everyone has a different idea about what is high and what is low. Okay. Right. So now I get exposed to a technical method. Now, what does this technical method do? And this is the relationship that people need to grasp. If they grasp this relationship, then they can grasp this idea that you can take the same set of criteria and end up with random results. And it's this. It's like what people realized years ago is that you can take data points. In other words, data points meaning what you're doing is you're translating the human, the human behavior, the human belief in if I'm going to buy
into something visual.
Was that no? It doesn't have to be visual, but it's like it could be. Yeah, it started out being visual. It started out being chart patterns based on bar charts. But what you do is that if I'm going to buy, it's because right now, let's say the last price is 10, and I put in an order to buy something at 10, okay? It's because I believe that the market's going to go to 11, or it's going to go to 12. Certainly if I thought or I believed it was going to go to 9, I would wait, would I not?
Correct.
So the reason why I'm buying at 10 is because that's what I believe. In other words, all price movement is based on people's belief about what's going to happen in the future.
Now you said to me in a conversation we had yesterday, obviously we as individual traders are not large enough in our accounts to move the market.
Exactly. And so this is the next connection that people have to make is that since all price movement is based on people's conviction or belief about the future, how do prices actually move? For an example, when you put in an order or I put in an order, I don't trade at a level where I can actually move prices. But what the typical screen-based trader doesn't.
But maybe one day we will be. Maybe when I hear those things like that, like you can't move the market, you're not big enough. One day I'm going to be that unusual option that people see. I'm just putting that out there. One day that's going to be me. They're going to be like, oh, there's an unusual option buy on Etsy. Yeah, that was me.
Doesn't understand is that there are thousands of traders out there who do move prices, and that it is their intention to move prices. Or you can have a large group of traders coming into the market and then cause prices to move. But what actually has to happen for prices to move is that if the last price of something is 10, for the market to actually move to 11, all the offers have to be taken out, meaning that, or move to 12, all the offers at 11 have to be taken out. So in other words, people who are trying to sell at 11, they have to get their orders filled before it can get to 12. Okay. Well, for someone to actually bid it to 11 or bid it to 12, they are doing the exact opposite. And this is really critical. They are doing the exact opposite in that moment of what it takes to be successful. Okay. They're not buying low, they're buying high. They're buying high relative to the last price. Or buying higher relative to the last.
So how does understanding this concept, how does understanding what moves the markets help our traders to take it to the next level? Is this the first step for them getting control and understanding how the market's working?
Yeah, they definitely have to understand. They have to understand how prices move, because when they understand how prices move, then they'll understand how their technical method relates to this movement. Because what technical methods do, whether it's a visual pattern or moving averages or any wise trade or whatever, you're using mathematical formulas. Okay, you're taking data points. In other words, you're taking what people believe about the future, transforming them or transposing them into a data point. As a price over time, okay, or with volume. There's any number, there's any number. That's what it ends up being, as a fresh cross. But I'm talking about the actual mathematical formula that makes the fresh cross. Okay. So there are any number of variables that go into this equation. Now, what people have found is that, and this is here, what people have found is that using these data points into certain types of mathematical equations, you can find patterns in collective human behavior. And what these patterns mean is this: is that when this set of criteria, okay, is present in the market, that there is simply a higher probability than not. In other words, there's a higher probability, or what I'm going to call an edge, a higher probability of one thing happening over another, that other people are actually going to come into the market and bid it higher from here or offer it lower from here. There's just, in other words, when the pattern is present, this collective pattern is present, it will repeat itself. But the problem is that it repeats itself on a random basis, because even though the actual mathematical criteria is exactly correct or exactly the same.
Mathematical models can't predict human beings.
That's right. Mathematical models can't predict who the actual individuals who are going to come into the market and actually do it. Right. In other words, it takes someone to do it. When you put on a trade, if you're not going to make your trade a winner by bidding the market, if you bought something by bidding the market,
using all of my money,
using all your money if you bought something at 10, you could actually wipe out all the offers and bid it to 11 or bid it to 12 or bid it to 13. Now the price is at 13. All the trades that you put on at 10 are winners, right?
Yeah, I still bought it at 11 and 12.
Yeah, but you're averaging up. But the point is, all the trades that you put on were winners. You actually made yourself a winner.
That's correct.
But what I'm saying is that when you don't trade at that level, we are actually obliged to other traders to come in to buy something at a worse price than what we thought was low to make us winners.
So what you're saying is most of us out there are dependent upon someone else to move the market for us. We're trying to identify that pattern, obviously using the Wise Trade software to find those common entries. But again, it's a random event.
Just have to put a disclaimer out there. Don't use the Wise Trade software. Use OVTLYR. It's way more better.
The edge you said in our favor.
Jared, when you put on a trade, okay, do you know who, now what we've done, we've reduced the market down to these terms, okay, that it takes someone else to make us a winner, right?
Correct.
Okay, when you put on a trade, do you think about who that might be, who might come into the market to actually make you a winner?
No, of course not.
Yeah, no. And if it turns out to be a winning trade, do you know who those traders were, or who that trader was that actually made you a winner?
No.
Is there any way to know?
No.
There might be, but it'd be pretty hard to find out, right? I mean, you could go to the clearing firm, the firm that clears the bottom line. Yeah, exactly. So what I'm saying is that when you're when the pattern presents itself, like, okay, I have an edge here. When the pattern presents itself, we don't have any idea of who is actually going to come into the market to do this for us. And so there's no point in analyzing. There's no point in judging. There's no point in in trying to figure out whether it's going to work or not. It would be like, for example, if I said to you, Jared, I'm going to give you a coin, and this coin is weighted in a way where it's going to come up heads 70% of the time. Right. Now, just because I know mathematically and statistically that this pattern of coming up heads 70% of the time exists, is there still any way for me to know the actual sequence, the heads to tails?
Of course not. It's an infinite.
Well, no, I'm saying, do I know the sequence? In other words, I'm going to flip the coin 100 times, and statistically it's going to come up heads 70% of the times. I still don't know which flips are going to heads. Which flips are going to come up heads. They say which flips. It's not the times. Right. Which ones? In other words, we flip the coin once, it comes up heads. Flip the coin twice, it comes up heads. The next one's tails. The next one's tails. The next one's tails. In other words, we could have streaks of heads or tails. Okay, we could have streaks in there. The point that I'm making is that there's no way to know the actual sequence.
But at the end of the day, we know we have
And that goes to the point that I was making earlier, where it's like, I can't guarantee you $10,000 a month. There's no one who can guarantee you $10,000 a month. But over the course of a year, you might average out $10,000 a month, and it might be $100,000 in a single month, and then a little bit here and a little bit there. There's no way to be able to determine, and Mark wants to call it reliable. I don't necessarily want to call it reliable. There's no way to say when you will get the outcome. And that's his point, right? Let me catch some in the chat. Cam says he also wants to move the market. Brian says MGM doesn't say you should win the bet or at the casino. Exactly. You shouldn't be emotional about your trades. And that's hard. We know that's hard. I know that's hard. I wouldn't ever say to somebody, you shouldn't be emotional, and just expect them to be like, okay, unless they've done like years worth of trading, right? I think I stopped being emotional about my trading when I had lost 2/3 of my account, right? I guess that would be like the first time I blew up. Yeah. After that, it doesn't hurt anymore, right? The stats are that 90% of traders lose 90% of their account in the first 90 days of trading. And so it's not unusual if you have blown up your account, right? I've done it twice. And that's why I say, I think it stopped hurting once I got used to being okay with taking losers, because that's part of the game. Sucks, but it's also part of the game. But then you get those times when you're on a winning streak and you're standing in the shower, you're lathering up your hair or what's left of it, and you're like, genius, such a genius. We've all been there too, right? But in the end, we couldn't control either of those outcomes. But we have very different reactions to both of those outcomes.
70%. So what that does, that obligates us, if we want to be able to trade our methodology in an effective fashion, to be able to utilize this methodology in a way where we can extract the maximum amount of profit that it makes available to us based on the pattern that it identifies. We have to do it in certain ways. In other words, our mind has to be free to be able to execute these trades without making trading errors. And the trading errors come from believing that because the pattern is present, that it's going to give me a winning trade on this one. This trade is going to be a winner.
You can't think that way.
No, you can't think that way. That's the way the typical trader thinks. Right. The typical trader thinks, I'm not going to put this trade on unless I think it's going to be a winner. Or why would I do it? So, and it skews our expectations. See,
that's a really, really, really good one. And that's something that people who aren't familiar with the market, they'll never understand. They'll never understand. Why would I put that trade on if I don't know if I'm going to win or not? Right? I couldn't convince my wife to trade. There's no possible way I could, because she wants that security. Why would I ever put on a trade if I think that I'm going to lose? That's a hard choice, isn't it? Why would you ever put on a trade if you think you're going to lose? Because you're potentially just as likely to win. And if you structure a trading strategy soundly, your wins should be so much bigger than those losses. But we can't control the outcome.
It messes our expectations.
Let's back up a couple seconds here. There's some great stuff here, Mark, and I hope our traders are getting all of this. You're basically saying, this makes a whole lot of sense to me, and I hope it's getting through to you guys. We have a tool that gives us an edge. Whatever it is. Even if that edge is 2% or 3%, I don't know if we can.
No, it's more than that.
Maybe more than that.
What do you mean more? There's a lot more than that. It's far more than 50%.
Well, I was saying greater than 50. I was using edge defined as, so maybe 55 or 56% of the time. Right. Let's just say.
And the thing is, it doesn't even have to be 50% to actually make consistent money. That's what people can realize too. That depending on what the ratio is between what you have to risk to find out if a trade is going to work and how much profit it generates when it does, you don't even need a 50% win-loss ratio.
Right.
As a matter of fact, back in the 80s, there are one of the most famous traders from the 80s, Richard Dennis, on a percentage basis. 95% of his trades were losers. 95%. But the 5%.
Richard Dennis, who I just talked about earlier this week, the man who had the turtle traders experiment. I didn't know his win rate was only 5%. He said something just a minute ago that I thought was really good. Let me see if I can remember as he keeps going.
Percent that were winners were monsters, and he was able to put on trades at a 95% loss ratio and make at the most at one point, I think around 1987 or 1988, he had $400 million.
Is that using his edge or his money management or a combination
of all of it? Okay. And see, one of the things he did too, and this is something I ought to really qualify with, he would use orders to actually probe the market. See, there's one of the things I don't want to leave what we're doing right now, but I'm going to just kind of divert just for a moment, and so that people understand that one of the first things to be a successful trader that you have to learn, other than the fact of finding a good edge, meaning something that puts a pattern, a collective pattern that your edge identifies, that puts the odds in your favor, that there's a higher probability of one thing happening over another,
which is very easy to do when you have outlier, right? Like the master key, SPY signal, market breadth, market trend, sector breadth, and then running your screeners, right? It's very easy to find an edge. And in fact, it's super easy to see the edge. Let me pop this down in outlier because it shows you what the edge is, right? You go in here, you click the performance summary once it loads in, and it'll show you what your edge is, right? Outlier has given us 73% return over time. That is an edge, okay? And there are ones in outlier that don't have an edge. Those I avoid. But when you see an edge, that is not the end-all be-all. That's not saying, hey, every time you put a trade on, by golly, you're going to make 73.24%. No. Because as you can see here on the chart, there are winning times and losing times. But on balance, overall, over a data size, a data sample set, you should have enough winners to outpay for the losers. Let me catch up on the chat here. Cam says, it's like real estate investing. I never fall in love with the deal until I know it's done and I know what the end result is. Absolutely. TrendSpider's having a 50% off sale this weekend. Go get it. Michael says, I think they mentioned that in the turtle. They sure did. That Dennis's win rate was dismal, but his profit on the winning trades blew his losses out of the water. I'm glad you read that one, Michael. But he didn't lose like most traders. He dumped his losers instead of hoping and praying. Instead of holding and hoping, right? Let me go back over here.
Once this pattern is present in the market, is that you have to learn how to think in probabilities. In other words, you have to get your expectations, aligned with the way the market actually exists. Right. And when you do, in other words, when you learn these kind of mental skills and you're able to execute your trades without fear and without hesitation, without analyzing, or even without thinking for that matter, because you don't need to think. I'll give you an example. A professional trader, what a professional trader thinks about when there's an edge present is, does he think about whether the edge is going to work? Absolutely not. Because he knows he has learned there's no point. Right. There's no point in analyzing or judging or building a case for or against whether that trade is going to work, because he understands the human component. Okay, but what he does think about is he thinks about the risk. How much do I have to risk? How far am I going to let the market go against this position to tell me that other traders are either going to come into the market and make me a winner or not? And he also has a plan for how he's going to take profits. Right. But the typical trader.
Does that sound familiar? Know when you're going to get in. Know when you're going to get out and why.
What does a typical trader do?
They don't have a plan. Or they think about the trade too much. They think about, is this going to be a winner? Is this going to be a loser for me?
The exact opposite of the professional.
So what the professional does is basically...
And then once they make up their mind that it's a winning trade, they don't predefine the risk, do they? Right. And they also don't have a plan to take profits because they think it's going to go on.
And I don't want to talk about that. We're running up on the break here, but I want to talk about that on the other side. But what you're saying is the bottom line is the professional sees the entry. He sees the pattern, whatever it is, the edge, enters in, not thinking if I'm going to win or I'm going to lose, but has a money management strategy in place, knows exactly how much he wants to win or is willing to win, how much he's willing to lose or risk.
Right.
Now, does he put a cap on the upside? Does he put a cap on his win
Well,
side?
it's not a matter
Or
of
a
a
goal?
cap. It's a matter of how, his assessment of how much potential there is. In other words, see, the problem is on a winning trade, we're
Before he gets too deep into this, I want to share with my rule, right? Selling into strength when it hits these certain targets, a 10-point spread on the heat map or a 5-point spread on the heat map. Because, and I don't know what he's going to say, when it gets deep in the heat map, when it gets deep green or deep red, let's see if I can find one that's deep red or deep green. Oh, here we go. No, I want to go back to COVID. That's the best. Yeah. When it gets deep red like that, I don't want to mince words. What do you
obligated. How, his assessment of how much.
Does he put a cap on the upside? Does he put a cap on his win
Well,
side?
it's not a matter
Or a
of a
goal?
cap. It's a matter of how, his assessment of how much potential there is.
How much potential there is, right? Because when it hits these extremes on the heat map, and we can see these, and this is why I use this as one of my exit signals here. When it hits these extremes, the potential for a bigger move is no longer there. We're already hitting an extreme greedy point. We're already hitting an extreme fearful point. So there may not be all that much more to go. Which is why I have these type of rules over here. Tug says clarity. Randy says, I have to work on selling into strength. A trade is not going to go up forever. Exactly. Let's go back to Mark.
In other words, see, the problem is on a winning trade, we're obligated in a sense to make these never-ending decisions as to what the risk-to-reward ratio is. In other words, as the market's going in my favor, what's the risk of finding out that it's going to go further? And that's why so many professional traders or people who teach trading advocate scaling out of positions.
Right. Mark, this is all great stuff. We're going to have to wind it up. We got to go to a break. Guys, it's already time, as I said, for a break. We'll be back with much more with Mark Douglas here in 3 minutes. We'll see you soon here on WTV.
Let me ask you this real quick. Do you want to continue going, or do you want to listen to this in your own time? Let me type a number 1 in the chat if you want to keep going, or number 2 if you want to just listen to this later on. It's up to you. Majority vote will win. Number 2 is or number 1 is we stay on. Number 2 is we bail after we get past this break thing here.
On putting your mind over the market. All
right, Cam is going to bail, but Dave, Tug, Michael's number 3. That's not even an option. Randy says 1. The ones have spoken. Thanks, Wes. Thanks, everybody, for voting. Let's keep going.
Jared Levy, Mark Douglas has been talking about psychology in today's market. Mark, let's continue with our conversation we left off with. We were talking when we left about the flip of a coin, and you said that you had a coin that was actually weighted on one side. You gave an example how a coin was weighted on one side, and over a series of flips, that coin had a 70% chance of, in this case, landing on heads.
Right.
Whereas in our software, we give you the edge, and maybe with our software, you have a better chance of being right or having a winning trade if you get in on a certain pattern.
Right.
You also talked about how
it's the word right that's really critical here. Okay.
Right.
It's the word right. In other words, what people need to understand is how.
I think I can quote him exactly about what he's about to say. There's 4 types of trades. There's a winning trade, a losing trade, a right trade, and a wrong trade. A winning trade does not necessarily have to be a right trade, and a losing trade does not necessarily have to be a wrong trade. Or good trade and bad trade. Yeah, I shouldn't say right or wrong. I should say good trade or bad trade. A winning trade does not necessarily have to be a good trade, and a losing trade does not necessarily have to be a bad trade. You can have a bad trade that's a winner, or a good trade that's a loser. It's irrespective of the outcome, right? If you followed your plan, that's what makes it a good trade. If you didn't follow your plan, that's what makes it a bad trade. And the very worst, he may say this exact thing, the very worst outcome that you could ever have is a bad trade where you didn't follow your plan, and a winning trade, a bad winning trade. That is the worst. You don't want that, because that messes with your mind. Because then you're like, oh, if I continue to do these bad things, bad meaning not following the plan, if I continue to do these bad things, then I should continue to get wins. Oh, this is great. I'm actually curious to see what he says, because I don't know if I quoted him exactly, but it's going to be really close to this. It could totally be totally different. But I just think that's where he's going to say.
How does believing in a random result affect your expectations? Because see, what we don't want is we don't want to get into trading with the possibility of being disappointed, or the possibility of being dissatisfied, or being even betrayed, because a lot of traders feel that way. They really feel betrayed. And the problem is that when that potential exists, it has the effect of affecting the way that we see market information in detrimental ways. Because in other words, all of us have these mental pain avoidance mechanisms that affect our perception of information.
Right.
So for an example, if I'm in a losing trade and I got into this trade thinking I was going to be right. Okay. In other words, I did all my evaluation, I did all my analysis, I did my work, I built a case.
Right.
It's like as the market's moving against me, I'm going to have the tendency to focus on information that tells me that I'm right and ignore the information that tells me that the market is actually trending against me. Okay. In other words, I can identify a trend, but I won't be able to identify that trend if I'm putting.
Okay, I was wrong. He's talking about something else. But I know exactly what he's talking about, and I know you know exactly what he's talking about. How many times have you been in a losing trade, and maybe you're trading on a daily time frame, and you're like, oh man, let me just go to the 5-minute candles or the 1-minute candles. Then every candle that pops in your direction, right? Every up candle, every green candle, you're like, oh, here we go. Let's go. Let's do this thing, right? And you're focusing on every little thing. And then you stopped seeing the obvious trend that's working against you, right? Imagine you've got a chart and it's all red candles, and then you get a one green candle and you're like, let's freaking go, right? You no longer are paying attention to the trend. You're focusing on the details that do not matter, because like you have blinded yourself to the reality of the situation.
An inordinate amount of significance on the information that's telling me that I'm right, as opposed to ignoring the information that's telling me that I'm wrong. And see, and overall, if we want to be consistent, the principle that we need to keep in mind is that to be consistent, we have to cut our losses and let our profits run. We have to make more on our winning trades than what we lose on our losing trades. And the problem is that if I'm susceptible to being disappointed or betrayed, meaning I get into a trade, expecting it to do what I think it's going to do, that I'm going to have this tendency to distort market information that causes me to hang on to my losers. And in a winning trade, what will happen is that instead of letting a winner run, markets don't go straight up. In other words, if I'm in a long trade, right, I would like the market to go straight up, but they don't. They go up and they come back and they come, and it's the retracements we focus on instead of the fact that the market's still trending in our favor.
So what you're saying right now, basically, is I found a stock, for instance, that I love. The stock just had a great news story. The charts are the same as the other stocks I've traded, but just for some particular reason, I feel great about this stock. Don't know what it is, but maybe they had some great news out, and I feel that stock starts to go against me. You know what? Based on the news that's out there, based on the special feeling I have about this stock, I continue to hold my loser. I continue to hold my loser until this thing draws down against me, and I'm in a major losing position. And I keep losing because I feel in my mind that I had some sort of special. This stock was special. Is that what you're referring to? Or?
That was the second time I blew up my account. The gold trade, I don't know what year it was. I wish I could tell you, but I was following this person on Twitter, and he literally had a monkey avatar. But I had seen him make great calls, so I was listening. And Bama Broker, if you ever go back in the Wayback Machine and look up Bama Broker on Twitter, that was who it was. I remember I remember specifically being on a little getaway with my wife to Fredericksburg, Texas, and walking down the main street there and looking at Bama Broker saying, oh, the Dow's going to do whatever today. And the Dow did that day. And I was like, oh my gosh, this guy is a prophet. I have to listen to everything he says. Well, then gold was in a downtrend, a very obvious, very clear downtrend. And Bama Broker came out and he's like, listen, now is your chance to buy as much gold as you possibly can. So I did. I put all of my account into GDX, GDXJ, GLD, Dust, whatever you could buy options on. I'm like, give me all the options. If you got options for sale, I'm buying them. Or calls for sale, I should say. Let's make that disclaimer. And every day, the market's going down and down and down and down and down. And I'm watching this and I'm like, maybe today's the day it's going to go back up, right? And we'll get one green candle. And I'm like, oh, finally, let's go. Yeah, this is how it's supposed to be. And then another 16 red days after that. And I remember going to Disney World and looking at my looking out the window of the hotel, and I don't know where it was in the Disney World area, but there's this like hot air balloon thing that goes up and down. And I remember looking out the window, beautiful hotel room we were in, right? And thinking to myself, what did I do that for? Because I still had the trade open. I would check into my account through the day as we're going, and just watching my account evaporate before my eyes. What was I doing that for? Why did I do this? Because I wasn't willing to see the data that was right in front of me. I was not able, I couldn't mentally look at the chart and say, well, that's a downtrend. Maybe I shouldn't be buying calls, because I was so blinded by having so much invested in that trade working out that I was completely blinded to see what was actually going on. Maybe you've been there too. I don't remember if I said this. If it was easy, everybody would be making money, right? We've all made big money on a mistake. Chris, I love your half ATR rule. That one rule can save me tons of money. Yeah, no doubt, dude. That's what it's for. Randy's laughing at my full portfolio. Give me a break, dude. I didn't know what I was doing. I was just trying to make some money.
Well, yeah, it could be anything.
Because I know traders do that.
Yeah, I know. It could be any variable kind of information that people latch onto.
Okay.
The thing that they have to understand is, regardless of the reason that they got into a trade, it doesn't, regardless of the reason, if other traders don't buy into that reason, or if other traders don't have another reason to want to buy at a price that's worse than yours. You bought the stock at 10. Right. Someone's got to want to buy it at 11. Someone's going to want to buy it at 12 and buy it at 13. And not only be able to buy it at 11, 12, and 13 and 14, they're going to have to take out all the offers, all the traders who think it's high. In other words, at 11, 12, and 13. And so if these people aren't coming into the market to do that, well, then whatever reason you thought you had might not be so good. Right. And so that's why it's so critical to predefine your risk before you even get into a trade. And that's why professional traders don't think about it any other way, because they know it takes other people. My reason might be great.
Professional traders don't think about it any other way. We have to predefine the risk before entering into a trade by position sizing and market on the chart where you're no longer going to be in there. Those are two ways that you predefine your risk.
Great. But if someone else isn't buying into it, what difference does it make? It doesn't matter, because it's not a winning trade. And so, if we have this susceptibility to be disappointed, what it does, it affects our perception of market information in a way that doesn't allow us to cut our losses.
How do we make ourselves not susceptible? I mean, how can you
by changing your perspective on this, by really understanding. For an example, Jared, you ever played a slot machine?
Yes.
Okay.
Now, I don't like it.
You might, okay.
But I played it.
Whatever reason you don't like it, doesn't matter, okay? That's good that you didn't like it, because it might make the example even better, okay? Okay? You play a slot machine. When you put your money in the machine, let's say it's a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel?
No.
Well, do you feel betrayed? Do you feel betrayed by the machine?
No, not at all.
And why do you not feel betrayed by the machine?
It's just a random, it's
a random outcome.
Ooh, this is really good. I forgot about this example. I'm going to back it up a smidge. I really want you to focus in on this. Really, really, really want you to focus in on this.
How do you feel?
No.
Button. When you put your money in the machine, let's say it's a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel?
No.
Well, do you feel betrayed? Do you feel betrayed by the machine?
No, not at all.
And why do you not feel betrayed by the machine?
It's just a random, it's a
random outcome. Okay.
He doesn't feel betrayed because he has the expectation of losing. Trading psychology in a nutshell. He doesn't feel betrayed because he understands that whenever he rolls that slot machine, there will be winners. And he understands when he rolls that slot machine, there will be losers. So when he has the losing trade, when he has the losing roll of the machine, not upset. It's part of the game. I think that's such a great example. Such a great example. Randy's laughing at me and Brian. Peter says, so how can you have a predefined exit point and let your winners run? Predefined exit point you do on the chart ahead of time. So let's just, for fun, do this, right? Let's say I want to get in to SPY. Look at that. It closed right under that order block. So it might or might not go away. I'm really not sure how close that was. Let's say I was getting in SPY right here. Right. I'm gonna predefine my risk by putting in a half ATR exit, which I'm just gonna round it. Let's just say it's right here at the bottom of this candle. Okay. And then I'm gonna let my winners run because I'm gonna let that go as far as it can. I'm not gonna handicap it. I'm not gonna say, okay, when it gets here, I'm out. Or when it gets here, I'm out. Or when it gets here, I'm out. I don't care. I don't care where it goes anywhere up here. I care a hell of a lot where it goes down here. And you should too, right? If it's going down here, I care a lot I care more than anything if it goes down here. But if it's up here, hey, anywhere up there is great. But then the other exit signals I have is not allowing, as Mark would say, it to go to where there's no more, or the opportunity becomes less and less. And we can measure that. This is a huge benefit in Outlier. We can measure this, right? Here, heat map shows, I'll make it bigger. Heat map shows like 36, 37, 36, 37, 34, right? Anywhere on here, that's really deep in the heat map. So I would only give it a 5-point spread because there are so many people who are so greedy at this point. There's only so much time before it reverses, and it did. Right? So it's not that you're limiting it on the chart. It's not that you're limiting it in price. It's that you're taking the perspective of, I have this data, which nobody else in the world has unless they have Outlier, which is really cool. And then you're looking at it and you're saying, people are getting really greedy here. They may have reached a point where all the people who are greedy have already gotten in. There's nobody else left to get in. And then the only people who are left are those that are fearful. And they take their money out and goodbye. Michael says, have a trailing stop. That's a great example. I will tell you though, I gave up trailing stops. I gave up trailing stops on the whole because I don't know how many times I got into a trade. Let's say I got in right here and it went up and it went up and it went up. And then by the time I got my trailing exit, I made next to zero or was even losing on the trade. So I do have some trailing exit criteria, like a 10 EMA being broken, but I would much rather sell into strength. If I can sell into strength, that means I'm getting out where it's really, really strong, right? I'm getting out while people are still trying to get in rather than getting out while everybody else is also trying to get out, right? It's the difference in walking out the door before the movie's over and walking out the door when the movie's over and everybody else is trying to cram through that door, right? You've got 200 people in the theater. Everybody's trying to cram out the door. And so you're just having to get in line until you can get out versus, oh, I got out 3 minutes ago without any issues. So I don't like to do that. I really like to sell into strength when I have the opportunity to. But of course, I can't tell it when it's going to. Right? I can't tell the market when it's going to sell into strength. All I can do is react.
So in other words, you went into it with the belief that you know that you're participating in an event with a random outcome. Right. And as a result, your expectations about the outcome were in perfect alignment with the event itself.
My expectation, believe it or not, was to lose. I know this sounds crazy, but when I put the quarter in, I thought, you know what, I'm probably going to lose this quarter.
Yeah, exactly. Okay, because the odds aren't exactly in your favor. And what trading systems can do is actually put the odds in your favor in a way where we own the machine. Believe it or not. I mean, this is the whole role reverses if you learn to think about it correctly. In other words, if you understand that, so for an example, well, let me backtrack a little bit and say that most traders, if you compare trading to a slot machine, the difference would be that with a slot machine, we can't play until we've accepted the risk. In other words, we actually have to take our money out of our pocket and put it in the machine, or otherwise we can't play. Right. So that implies that we've accepted the risk, because the degree to which we have not accepted the risk, we wouldn't be able to put our money in.
That is our loss.
By putting your money in, be it a quarter, a dollar, whatever, you've already limited your losses, right? You can't pull a slot machine unless you've put in money to start with. And you can't pull a slot machine and lose your house, right? Unless you decide to put your house in the slot machine. I don't play those high roller stakes, no way. But similar thing in a trade, right? If you can't handle the risk, you shouldn't be taking the trade, which is one reason we size based on risk. Wow, look at that. How everything just ties together. This is so great to have today. Wes says, I love your idea of rolling up strikes and reducing delta risk. Wasn't my idea, my friend. I actually got it from, I always like to quote who I got people from, because as I said earlier today, I just stand on the shoulders of giants, right? All these people who have taught me everything, I just do my very best to relay the information to you. I got that from Michael Coe, who, there was a show on NBC called Options Action, and I had the opportunity to work with him just a little bit. And that was one of the questions I asked. It's like, hey, when things are going my way, I want to take profits. What do I do? And he's like, just roll the option up. It's like, what do you mean roll the option up? He's like, just move from strike A to strike B, closer to the money. And then you can have profits now, and you can keep the trade on. I was like, wow, that is cool. But yeah, that's why I do that.
The quarter is our loss.
That's the risk. No, that's not our loss. That's just the risk. That's just how much we're willing to invest to find out if it's going to work. Okay? And then what we do is we wait for a pattern to show up. And if the pattern's a jackpot, great. If it's not, then we might be willing to put another quarter in the machine to find out if it is. The difference with trading, and this is where people's mental idea of what this is all about gets messed up. The difference with trading is that the pattern shows up in the market. The pattern shows up first. Okay? Then what we have to do is put up our money. Meaning, how much am I willing to risk to find out if it's going to work? But most traders, because they evaluate, because they judge, and because they analyze, they think that and build a case for the pattern being right, they actually talk themselves out of believing that the risk even exists. They might give lip service to the idea of putting a stop in the market, like some of those errors that I said in the beginning. How many people put stops in the market and take them out, and then let what would have been a small losing trade go into a big losing trade? That's lip service. You see, well, okay, I've been told over and over again I got to put stops in the market, so I'm going to do it, but they haven't really accepted the risk.
They haven't, every day.
Yeah, they haven't really truly accepted the risk because they don't want to be wrong. And what they have to understand is that this is not a right or wrong game. This has nothing to do. Trading a technical methodology or a technical pattern does not have anything to do with being right or wrong. It's just an odds game. That's all it is. In other words, you get an edge that says I've got the odds in my favor over a series of trades, but you've got to be able to take every single trade because you don't know the sequence, the wins and losses. You got to be able to identify what your risk is, and that's simply how much am I willing to spend to find out if other traders are going to come into this market and bid it higher than my price or offer it lower than my price if I sold. That's all it means. And then, of course, you have to have a money management plan for how to take consistent profits.
Right. Which is another problem I want to say.
Oh, yeah. But see, the thing is like when you change your perspective, when you change how you think about this, okay, it's like I know there's a random outcome to these patterns. And so I know it's not right or wrong. And so what potential do I have to get disappointed? No more potential than what you had.
It's not right or wrong. Key in on that. He said it's not right. It's not wrong. It's just price movement up or down. You are not wrong. You as a person are not wrong. I can't tell you, I think it was years that I tied my self-worth up with how much money I made in the market or how much money I lost in the market. If I was making money, I felt like $1 million or multiple million. If I was losing money, I felt like the lowest of lows, right? Couldn't even stand up straight. You are not right. You are not wrong. Unless you completely botch your trading plan. The outcome has no determination on that. It's just price movement up or down. The way you go wrong is not handling it in the way that you've predefined your risk.
Had to get disappointed by putting a quarter in a slot machine and it didn't come up with a jackpot.
Right.
You see, this is the critical thing here, Jared. You got to be able to change the way you think. This is what's the title of this program? Mind over markets. Okay, you got to be able to change the way you think. And
how does a trader do? I mean, what are the steps? I mean, pal, is there obviously by reading your books, by getting themselves immersed in your thinking is certainly a way to do that. Is there anything from this point forward a trader can begin to do, or thoughts that traders can try to add to the repertoire to begin to think like a professional trader, have that carefree state of mind, and start to change the way that they view the markets and their risk? Is there an exercise? Yeah,
absolutely. I mean, there's an exercise in trading in the zone, exercises in how to think like a professional trader, and basically all it really takes, Jared, is simply a sincere willingness to do it. Honest to God, it's just like anything else in our lives. When we realize that there's a particular goal that we have, and there's a strong desire to achieve that goal, then we're going to take whatever steps we need to achieve it. Whether those steps are trading in the zone or how to think like a professional trader or some other methodology that people are more comfortable with or whatever. The point is that if someone really sets their mind, any of us, when we really set our mind at getting something, we'll get there. We will get there. But the difference is, like we started out in the beginning of the program, the difference with this is that what we have to set our mind at is how to change our mind. Okay? And that's why there's so many people who are so close to getting it, but never really get beyond that threshold.
That hurdle? Why can't?
Because people don't want to change the way they think. It's that simple. People don't like changing.
How can people get to the carefree state of mind that you talk about?
By changing the way that they think. They've got to eliminate the potential to think that the market's going to disappoint them. They've got to eliminate the potential to think that the market's going to disappoint them. And the way they eliminate the potential is by understanding that trading is not about being right or wrong. It's a probability game. Right. If you're trading technically. Now, I don't want to confuse people, but I got to say something else. Is that traders do evolve.
An hour and a half, by the way. Keep going.
Do? Oh, yeah. I got that long, honest to God.
Go ahead.
Oh, my. No, is that there are stages of development. In other words, and I think I started to talk about this in the last segment, is that there are stages of development. That we start out learning these fundamental skills, like learning how to think in probabilities, so that the market doesn't have this potential to cause us to feel emotional pain.
Right. We did everything we could. We had our edge. It didn't work out.
That's right. And that's all it is. When you put on a trade and it doesn't work, all it really means is this: is that some of the traders didn't come into the market that had the same belief that you had, or the same conviction that you had about this market doing whatever it is you thought it was going to do. That's all it is. It's nothing more than that.
And you have to learn to walk away.
You have to learn to walk away. I mean, let's put it this way. How good do you think the average person is at predicting other people's behavior? In someone else's behavior. People aren't that good at predicting other people's behavior. Or even their own behavior, for that matter. Okay, exactly. They find themselves doing things that what am I doing this for? You know, and so how good are they going to be at predicting collective human behavior? Now, the methodologies that we have access to, these mathematical formulas, do that for us.
Right.
But you have to understand that there's no possible way that these mathematical formulas can predict the outcome of these patterns on a trade by trade basis, only on a series of trades. In other words, what they're really saying is that I have the odds. So when I get a signal from my methodology at the very most fundamental level, what this is telling me, right, is that
fresh cross.
There's a higher there's a high, or let's say the odds are in my favor. The odds are in my favor that somebody is going to come into the market. This is what the pattern means. Right. The odds are in my favor that somebody is going to come into the market and bid it higher from here if I bought, or offer it lower from here if I sold. That's all it's saying. Now they're either going to come or they're not. And so as a result, I don't look at this as being a right or wrong. I look at this as how much distance am I going to give the market to move away from my entry point to tell me that they're either going to come or they're not, and any further is not worth the money of finding out, not worth the cost of finding out. That's all it means.
Do you talk about stop losses? You talk about stop losses and management in your DV?
Yeah, absolutely, but not like very specific. Not the kind of specifics that, like if you're in a half an hour time frame, how much.
Well, that's the trader's decision. Yeah, but the trader, dependent upon their trade style, is going to adjust their stops according to their account size, according to the risk tolerance, etc. Right. What you do, I think, is give people an understanding and a basis of where they should be placing their risk, or how much, not from a dollar perspective, but maybe from a
in other words, so that they can, from a mental perspective, so that they can adjust their trading style in a way that conforms to where they're at in terms of their ability to take the risk.
Would one exercise be for a trader to begin testing out their loss? In other words, take a $100 loss, see how you feel. If you're able to take a $100 loss and walk away and not fret too much about it, not let it stress out the rest of your trading day and not think about it, maybe then you could say, okay, I'm willing to trade a more volatile stock and move to something like a $200 or $300 loss, etc. Is that an exercise you think would be beneficial?
Oh, absolutely. Yeah, absolutely. And that's what I suggest to people, all the time, especially, I was doing coaching. It's like, and when I was doing coaching on an active basis, I was coaching some pretty substantial money managers, and, they'd get into a situation where they're on a pretty good losing streak. And often it required that they actually go back to a risk level that, they hadn't. Meaning that if they were trading, 10,000 or 100,000 shares, or willing to take, $500,000 or $1 million hit on a trade, to get back to where they felt more in sync with the market, that they may have had to go back to only trading 1,000 shares. Mm. And see, and when you're working in a corporate situation like that, with other traders, that's often a hard thing to do, but that's exactly what they needed to do. I suggest to people that look at it this way, paper trading. Okay, paper. A lot of people who teach trading say that there's no point in someone paper trading, because there's oftentimes a huge difference between the results they'll experience paper trading and what they'll experience when the real money's on the line. Yeah, because there's no real money on the line. In other words, I'm sure there are probably a substantial number of viewers out there who can make consistent money following their methodology of paper trading, and then they start doing real trading, and everything changes. Okay, well, and so a lot of teachers have said, well, there's no point in paper trading because there's no correlation between the results. Well, that's not really true, because what paper trading can do for people is very, very beneficial. One, it's a graphic demonstration of the gap that exists in terms of mental skills that they need to acquire. In other words, it's a good way to get familiarize yourself with your trading platform. It's a good way to really get confident with your methodology, but more so, it is a graphic representation of the mental skills that you don't have. That's an
interesting concept.
Yeah. So in other words, how does someone convince themselves that they need those mental skills? Look at your paper trading in relationship to your real trading. Mm-hmm. Now, if there's and a lot of this, even if people have learned to think in probabilities, which is what we've been talking about pretty much this whole time, even if people learn to think in probabilities, it doesn't mean that they can really still accept the loss, right? Because the way our minds think. In other words, In other words, if I have to take a loss on this trade, it could have the tendency to tap me into all the accumulative kind of negative pain of every time I've had to take a loss in my life. And it just doesn't mean in trading. It could mean, pets or what, people and that sort of thing, or jobs. And so, because our minds have this tendency to associate, it can make it difficult to accept the loss. So a lot of times what people would have to do, and they also would find difficult to do, because a lot of times people get into trading because they want to impress their friends or their family, like, I'm a trader. Right. But what they might have to do is that when they graduate from paper trading, they might just, the amount of risk tolerance they have might only be just 10 shares and risking $1 on those 10 shares. And you think, well, what's the point of that? Well, the point of that is that, when you can trade those 10 shares flawlessly based on whatever your methodology says, and do it without any fear or,
because you were able to make those trades in the paper. I mean, you made those trades in the paper.
Then you can go to 20 shares and see how that feels. Then you go to 30 and gradually work your way up. And people aren't willing to gradually work their way up.
This is a concept that we've never even talked about. I've never actually heard it put this way, Mark. I have to be honest with you, where you look at your paper trading account as kind of almost your goal, if you will, almost like, this is where I could be if I was trading from a carefree state of mind.
Absolutely. It's perfect. This is where I could be if I had that carefree state of mind. If I had the mental skills that allowed me to do exactly what I need to do without reservation, without hesitation, without fear. And that's the way that we can, and that's, and that's basically what we're getting at. How do we use the methodology that we have and the capability and the potential of that methodology to its maximum? You need the mental skills to do it.
You made reference before, both at WiseFest and earlier we talked about some events and pain in your life, and a lot of our traders right now feeling some pain with what's been happening in the markets the past couple of weeks. Mark, is there does a person have to experience this, a total drawdown in their account, a total loss in their account where their account's almost wiped out or is totally wiped out, for them to make that change in their mind? I mean, does that have to happen? Does it have to be traumatic like that for them to realize, oh, I've got to change something? And I'm saying this, and obviously it can be done without that, but have you found that predominantly out there, in the people you've taught over the years, have people had to experience a high level of trauma before they can actually make the change? Or can someone just in the normal course of every day with a little bit of dedication actually? And I'm not trying to be rhetorical. I really want a serious answer, because there's people out there right now that I'm sure are thinking the same thing. Do I have to lose my whole account? Does this have to happen for me to make a
You're in pain right now, are you, Jared?
Yeah, I'm good. I've been out of the market all week.
Yeah, well, you mean like the gutter principle?
Yeah.
Is that what you're referring to?
Explain the gutter principle.
The gutter principle, in other words, how much in the gutter do you have to be before you're willing to say, I'll do anything? As a matter of fact, this kind of brings something up, is that when I was actively coaching, my coaching clientele basically fell into two broad categories. One was with traders who were already successful, who were already consistent, and what they wanted were, they wanted fine tuning. Okay, they wanted creative ways of fine tuning themselves so that they could actually increase their, increase the amount of money that they make over a year, whatever. And then you had the other group was they're literally in the emotional gutter. Okay, they're so exasperated, they're so frustrated because of the potential that it's so obvious what the potential is, and yet there seems to be these invisible barriers that keep them from getting into that potential. That they come to me saying, I'll do anything. And that's, now everyone has different tolerances of pain before they get to the point where they say, I'll do anything, and mean it, and be sincere, and mean it. That's the whole thing. They got to mean it.
Mark, we're wrapping up the show. We have a couple more minutes now. There was a couple points I know you wanted to make before we end up the show. And guys, just so you know, next show we're going to open up to phone calls and emails. So if you want to start lining up your emails or your phone calls, do that now. Mark, a couple more minutes to go. In this arena, I mean, is there any message you can give to our traders, or any final thoughts, maybe a mantra, something?
No, just basically just to kind of, sum up what we've been talking about, that if consistent results are your objective, then you're going to have to learn how to think like a professional trader, because that's what they do. They make consistent results. That's why they're pros. That's why people give them their money to manage. That's why they have jobs where they actually trade for a living, because if they didn't make consistent results, they wouldn't keep their jobs. And so to do that, you have to learn to change the way you think about trading in a way where it doesn't cause you to have this potential to think that you're going to be disappointed or betrayed or put you into a state of emotional pain. It's like getting to that carefree state of mind. And once you get to that, once you shift your perspective, everything changes. It's not about being right or wrong. And when you really understand that, and then you go through the process of learning how to accept the risk of losing, then everything about your trading will change.
So when the patterns present themselves, you trade them.
You trade. You don't think about it. There's nothing to think about. It's like, don't think. There's nothing to think about.
And you trade within your means.
Except the risk and how you're going to take profit. But I'm saying to
that point, when the pattern presents itself, you trade it, right? When everything lines up, you trade it risk-free, fear-free, because you know what the outcome will be, at least on the risk side. You don't know how much you could make. You have no idea how much you could make. It could turn out to be amazing, but you do know how much you're willing to risk, just like running the slot machine.
pattern itself, when the pattern presents itself, there's absolutely nothing to think about.
That is the
because there's no
objective part
way
about trading.
you can know. Yes, there's no way you can know what the outcome is going to be.
Mark, we do have another hour, like I said,
Okay.
so we've got plenty more time.
All right, let's wrap it here. That was really cool. And I'm really proud of everybody who stuck around and watched the whole thing. And of course, those who are watching this on the replay, I'm proud of you for watching it too. I hope that this was useful. Let me know in the chat. Was this useful to you? Was this worth our time today? Right? We've been going for nearly an hour and a half at this point. I apologize for taking over so much of your day, but at the same time, this is really good stuff. He's the godfather of trading psychology. Every other trading psychology book wishes they could be as good as Trading in the Zone, which you're going to buy before the weekend's out, and you're going to read it over the next couple weeks. It's not a difficult read, and it's only not that long, is it? Right around 200 pages. So you could get it done really quickly. Dave says, very much so. I appreciate it. You're welcome. You're welcome. Before we go real quick, let's just wrap this up. Thank you so much for being an outlier, right? We couldn't do this without you. And we want to pay you back every single day by helping you save time, make money, start winning with less risk. And of course, be sure to go get Outlier's lowest pricing of the year, which will be up until September 30th. After that point, prices will be going up. The annual pass is only $299, which is literally 82 cents a day. So I don't want you to miss out because we'll be raising prices on that soon. Peter says, very useful. It was great. Thank you. You're welcome. Excellent room today. PhD level. The mind game of trading. Absolutely. Thank you all so much for coming today. Have an incredible weekend. I'll see you right back here on Monday. We'll talk soon.